Welcome back, everyone. We have some breaking news. We're going to be talking about Netflix's earnings report. I have the letter right here. I have the results, I have the numbers, and we're going to be diving into it, going over everything. And Netflix is a company that I'm not new to. It's one that I've been invested in for a long period of time. I have it as one of my largest holdings in the Story Fund, which is my more aggressive, riskier portfolio. Netflix is one of the companies I feel strongly about. So I've been invested in this one for quite some time. And this has been a crazy holding to invest in. It's just been incredibly volatile. But we're currently in the green a little bit on this company. And right now, if we look today after earnings, and this is just literally minutes ago, if we look at how it's trading right now, it's down 3.47%. So we're seeing a little bit of selling, but honestly, this is not bad. Down 3%. If we take a look at Netflix's history, year to date, it's up 61%. We look at the past trailing 1 year and it's up 119%. So up 119%, just in the past month, up 10%. Am I okay with a little 3% sell-off? Yeah, that's basically a win as far as Netflix is concerned. What we're really concerned about is a disastrous quarter, one that causes a 20% sell-off. So this right here, I don't think this is concerning. This is going to put us back a couple days, maybe. That's basically it. And in general, I don't like reading into the immediate after market reaction to an earnings report because it doesn't illustrate what the intrinsic value of the company is actually doing. So if we dive into the actual report here, let's go ahead and just read what Netflix puts out here. In summary, they say, in May, we successfully launched paid sharing in 100 plus countries, representing more than 80% of our revenue base. Revenue in each region is now higher than pre-launch. So in every single region, revenue's higher than when they launched this, with signups already exceeding cancellations. Paid net additions were 5.9 million in Q2, and today we're rolling out paid sharing to almost all of the remaining countries. So right here we have paid net additions of 5.9 million. Net additions means the company's always losing subscribers and always gaining subscribers. Every day they're losing thousands and thousands and gaining thousands and thousands. This is the net between the two. So they came out with 5.9 million more this quarter than when they started. And this is a huge beat over the street. The street had this at around 2 million. So they literally tripled the amount that the street was looking for. Huge victory there for Netflix. I have to assume that, that's got to be what's holding the stock up a little bit. It's going down a little bit more. Maybe we'll see a continued sell-off. But I don't view that as bad news. The company literally gained 6 million subscribers in the quarter, 3 times as much as the street expected. Our Q2 2023 revenues of 8.2 billion and operating profit of 1.8 billion. So this was where they missed. They beat their earnings per share estimate by a wide margin, but they missed on their revenue ever so slightly by like 100 million or something. So they had a small miss on revenue there, and that's probably why the street is selling it off a little bit. They say that they were generally in line with their own forecasts, and we expect revenue growth to accelerate in the second half of 2023 as we start to see the full benefits of paid sharing, plus continued steady growth in our ad-supported plan. We're still targeting a full year 2023 operating margin of 18 to 20%. The street has that at 19%. So that's in line in terms of their forecast with expectations. And they are expecting reacceleration of revenue growth the second half of this year. They say that we are the leader in the streaming engagement, and per Nielsen, we had the top original streaming series in the US for 24 of the first 25 weeks of 2023. The top series for 24 out of 25 weeks, and the top movies for 21 weeks. Netflix they're the dominant leader right now. It's an argument I've been making for a while. Now it's more widely accepted that Netflix has basically won this game. I think they're on easy street now. I think the company has a very reasonable runway of growth at this point. So we have the revenue of Netflix. This has been a part that's been a bit disappointing. The revenue slowing down over the past trailing year. But as they're reaching scale, this incremental revenue, more of it's going to the bottom line. And they're actually accelerating. They're forecasting next quarter revenue of 7.5%. So a speed up over the past year. That's good news, I think. We have operating income. That looks like it's also in line with expectations, accelerating. The operating margins look good, in line with expectations. The net income of 1.488 billion. So they're still producing net income. Now, a lot of people have problems with their earnings and net income because of the way they capitalize and amortize their content, but they have right here their free cash flow. This doesn't include stock-based comp, so I'd have to factor that in as well. But their free cash flow, the way that they calculate it normally, is 1.33 billion for the quarter. So they produced 2.117 billion last quarter and then 1.339 billion this quarter. This is a cash generative company. Every single quarter now producing free cash flow. And I believe that they have ample control over this. With their content budget and steady revenue growth, they have a ton of operating leverage. They've already made their free cash flow. They just need to keep it in the positive, basically for the second half of the year. Now, their estimates were that they were going to have $3.5 billion in free cash flow for 2023. I've said over and over again, I think they're going to beat it. I think they're going to come in well above 3.5 billion, and not just because of the writer's strike. I don't think that that's going to be the most impactful part. When I look at this, I see a company that's reaccelerating growth, that has a clear victory over other competitors. It's now cash generative, moving up its free cash flow dramatically quarter by quarter, marching towards an extremely cash generative company if they can get the next 2 quarters good. I like what I see. So again, so far, I really like the report. I completely, once again, disagree with the market. The market's looking at this and finding something they don't like and selling it down a little bit. But a lot of this can be driven by emotions and algorithms and all that type of stuff. And I think investors need to be careful here. When I look at this report and I look at the intrinsic value of the company and what way fundamentally the company is going, it has higher revenue than it did last year. It has more subscribers, 6 million more than it had last quarter. So they're gaining subscribers, they're gaining revenue. Their margins are increasing. Their forecast is of revenue growth, revenue reacceleration. We go to their cash flow and capital structure. They say that net cash generated by operating activities in Q2 was 1.4 versus 0.1. So they went from 0.1 billion to 1.4. A huge increase there. The free cash flow in Q2 2023 amounted to 1.3 billion compared to about break even last year. So they went from basically no free cash flow to 1.3 billion. And then assuming no material swings in foreign exchange, we now anticipate at least 5 billion in free cash flow for 2023. That's way higher than their previous expectation. Their previous was 3.5 billion. And I bet that's because of the writer's strike. They say that we moved it up from our prior estimates of at least 3.5 billion. Our updated expectation reflects lower cash content spend in 2023 than we originally anticipated due to the timing of production starts and the ongoing WGA and SAG strikes. While this may create some lumpiness in our free cash flow from 2023 to 2024, we plan to deliver substantial positive free cash flow in 2024. So they're not saying that this is just a one-time event, that 2023 is going to be great with free cash flow and then it's going to die back down in 2024. They're saying that this is going to be positive, substantial, both years. A lot of investors are going to make the argument that the only reason that Netflix can generate free cash flow is because of these strikes. And that is it's not accurate. They were generating free cash flow before the strikes. They'd already projected 3.5 billion before the strikes. The strike is going to make it so that they can't spend as much money, so they're going to generate a little bit more. My opinion is the longer the strike goes on, the more it benefits Netflix and the more it hurts their competitors, because Netflix has far more of a content pipeline than most streamers. They say that we finished Q2 with gross debt of 14.5 billion, in line with our 10 to 15 billion targeted range, and the cash and short-term investments of 8.6 billion. During the quarter, we repurchased 1.8 million shares for 645 million. We now have a 3.4 billion of capacity remaining under the 5 billion share buyback authorization. We currently are running a bit above our target minimum cash level. So we expect to increase our stock repurchase activity in the second half, assuming no material changes. So they're going to accelerate their buyback program. They have too much cash right now. That's it. That's the Netflix report. Now, I'll have more details on this and further analysis diving into all the nitty-gritty financials and everything. But my impression on this so far is I view it very positively. There's a couple little things that you could critique here, but when I look at the main drivers of Netflix intrinsic value, I see all of it moving in the right direction. So for me, even though this has been a crazy hold, a company that's really volatile, I'm still on the journey. I'm still holding on to Netflix. I think it will beat the S&P 500 over the next couple of years. That's all for this time. See you in the next one.